Norway's Sovereign Wealth Fund closes Shanghai office, leaving China. China's near future, no financial crisis, but no healthy growth. China Education Group staff were asked to obtain loans for the company. Dramatic turning point in US-China Chip War? It's all covered in today's China Truths. Norway's Sovereign Wealth Fund closes Shanghai office, leaving China. Norges Bank Investment Management Company, the world's biggest single owner of equities, is leaving China, joining other global financial institutions in winding down their operations in the world's second-largest economy amid a deteriorating economic climate. In detail, on September 7, Norway's $1.4 trillion sovereign wealth fund announced its decision to close its Shanghai representative office due to operational considerations. The fund is shifting its operations to Singapore, which has served as its Asian hub for over a decade and currently employs 45 individuals handling various operational functions across Asia, including China. Even so, the fund's deputy chief executive Trond Grande told Reuters that the move will not affect the investment strategy in China. However, in August, Grande told Reuters after the fund's half-year results that its biggest worry geopolitically is a world where China and the US are increasingly in competition with each other and hence creating a decoupled world economy. Norges Bank Investment Management Company opened the Shanghai office in 2007. As of the end of 2022, the company had invested approximately $42 billion in 850 Chinese companies. Before closing, the office had 8 employees. The fund's closure of the Shanghai office mirrors a shift among other global financial institutions, which have been quitting China or scaling back their ambitious expansion plans in China. Notable examples include major international investors such as Goldman Sachs and Morgan Stanley. Goldman Sachs has recently revised its 5-year plan forecasts and laid off a tenth of its staff on the mainland after doubling headcount to over 600. In November 2022, Moody's shuttered the China operations of its risk management division, laying off about 100 people. In addition, Moody's Analytics also closed its offices in Beijing, Shanghai, and Shenzhen for operational problems. Analysts believe that the extensive regulatory crackdowns carried out by the Chinese Communist Party authorities in recent years, with continuous raids on foreign companies, and the lackluster growth prospects of the Chinese economy have all made foreign investors uneasy. China's near future, no financial crisis, but no healthy growth. With the downbeat economic news and real estate developers staring at bankruptcy, questions about the path of the Chinese economy raise more concerns. Due to the concentration of real estate and banking concerns, the most obvious question is this: will China soon have a financial crisis? In the article Will China Have a Financial Crisis or Continue Growing?, published September 9, author Christopher Balding thoroughly explained the situation in China and presented an insightful answer for the question. Mr. Christopher Balding was a professor at the Fulbright University Vietnam and the HSBC Business School of Peking University Graduate School. To begin the analysis, we should know that since the 2008 global financial crisis, pundits and analysts have been obsessed with the latest crisis du jour. A type of post-traumatic stress disorder seems to be besetting every self-appointed financial guru with predicting the next collapse. In defense of the China Chicken Littles, similarities do exist between 2008 America and 2023 China. Consumers borrowed extensively on the back of rapidly appreciating home values as banks lent excessively to households and developers, failing to account for a variety of risks. China defenders have made a different comparison to the Japanification of the Chinese economy. High real estate prices, coupled with a rapidly aging population and a state-influenced economy, lead to long-term stagnation. Each picture has enough similarities and differences to warrant consideration. Before attempting to answer the big question, let us take a step back and ask what exactly constitutes an economic crisis and continued economic growth. To many observers, these questions seem obvious but become more difficult in practice. Would the failure of a major Chinese bank constitute a crisis? What if China unilaterally devalued the yuan by 50%? Conversely, what if Chinese growth continues to expand by building more unused infrastructure and homes? We must resist the temptation of requiring history to repeat but allow it to rhyme to make sense of a unique economy with novel pressures and objectives. The economic event comparisons fail to consider key variables. For example, unlike the United States, Japan, or other countries, we might point to China not being a democracy. In 2008, U.S. voters chose Barack Obama and moved forward, and other countries from Japan to Spain, facing deep economic issues, voted for new representation at various points. China does not have that option. In fact, more than simple discontent with a leader, the Chinese Communist Party, CCP, has staked its ruling legitimacy on delivering results to its people. We should be very cautious, however, in jumping to the conclusion that any slowdown or event will result in a crisis. Beijing, knowing any financial crisis could result in a once-a-century global event, has a vested interest in ensuring there is no crisis. The very real threat of death or imprisonment has an uncanny ability to focus the minds of regulators and cadres to prevent a crisis. China has immense resources that will help it to prevent a crisis. From extremely tight control of the population, businesses, and institutions such as media and regulators to opaque data that will help it hide or cover up problems, Beijing has more tools at its disposal to turn back the tide of a financial crisis than any other government probably in history. By no means does this guarantee its ability to prevent a crisis of some kind, but it dramatically improves its ability to prevent it. However, we should be just as cautious in assuming this implies Beijing possesses the knowledge or objectives to facilitate a healthy functioning economy promoting welfare-improving growth. Beijing continues to prioritize state enterprise and state objectives above a healthy private enterprise and consumer welfare. This has important implications for future growth and crisis avoidance. Though many conceptualize the low level of household consumption as a policy error, it is, in point of fact, the very heart of Chinese economic policy. By keeping social benefits such as health insurance and unemployment benefits very low, households engage in preemptory savings. Those savings are recycled through purchases of real estate with large implicit taxes that flow to government coffers or are deposited at large state banks that fund government priorities in infrastructure and national development. State-directed investment failing to earn a return then requires ongoing subsidies in a variety of forms that come from financially repressed households. The reality is that China can keep growth going and avoid addressing its financial cancer for many years into the future. GDP growth is, at its core, a measure of activity and does not mean it needs to be productive or beneficial for the workers or investors. To borrow an economic textbook example, an economy can count the labor payment to both dig a hole and then have the laborer who dug the hole pay someone else to fill the hole up. Theoretically, these two workers can pay each other to dig and fill holes up, rapidly expanding GDP even if neither grows richer or more productive. Since around 2005 to 2008, Chinese productivity, the primary metric of long-term economic health and rising wages, has been weak at best or even negative, according to some studies. China is effectively digging and filling up holes at a massive level by building so many homes and infrastructure that it will never earn the necessary rate of return. By continuing to close its economy to imports while maintaining a large US dollar trade surplus, which is expected to account for an amount equal to 10 to 12% of household income in 2023, China can delay confronting the problems but keep infrastructure-led growth and employment high enough to avoid a collapse for some time. This does not mean it will see healthy growth, addressing the underlying financial weaknesses or policies to improve competitive productivity. It means Beijing will keep the economy strong enough to avoid significant events and stay in power. It is rumored that on a trip to China, the Nobel Prize-winning economist Milton Friedman was shown a valley of Chinese workers building a dam with shovels. His government host proudly commented on all the jobs that Beijing created, to which Mr. Friedman commented, "If it is jobs you want, give them spoons instead of shovels." China has shovels, excavators, and artificial intelligence in 2023. Unfortunately, those excavators are busy building infrastructure or homes that will go unused, and artificial intelligence monitors worker time spent reading Xi Jinping thought on an app rather than on productivity-enhancing activity. Do not expect a crisis in China anytime soon, but neither should we expect welfare-enhancing growth. Beijing can prevent a crisis and maintain good enough growth by tightening further. Expect more of the same, but only worse. China Education Group staff were asked to obtain loans for the company. Recently, Hunan Zhengzhou Yuran Education Group asked teachers and employees to borrow loans to support the company. This movement attracted public attention. According to reports, the group has allowed teachers and employees to obtain loans from Zhengzhou Rural Commercial Bank for corporate use in the past 3 years, with a total loan amount of more than 20 million yuan. According to recent revelations from employees of Zhengzhou Yuran Group, the group also applied for loans for employees without their full knowledge. Some employees said they just went to the bank with their documents and only found out afterwards that they had been loaned. After the loan was processed, several financial staff of the group began to ask everyone to transfer the loan money to the designated account. The statistical table released by Zhengzhou Yuran Education Group shows that in January 2021, 181 people in the group received loans of 26.02 million yuan in total. Currently, some of the employees who have borrowed money from Zhengzhou Yuran Education Group have overdue loans and their credit records have been damaged, and some employees' loans are about to expire. On November 19, 2021, the table posted by the group showed that 135 people still had loans. According to Chinese media reports, at the end of 2019, Zhengzhou Yuran Education Group held a mobilization meeting to encourage employees and teachers to lend money to the group to help the group tide over difficulties. Each person can get a loan of 100,000 to 150,000 yuan under the name of decoration loan. In order to encourage employee loans, Zhengzhou Yuran Education Group promised that after the company pays interest at a fixed interest rate every month, the remaining amount in the account will be a reward for employees. For example, the monthly interest payable could be 660 yuan, but the company would pay 1,330 yuan at a fixed interest rate. The remaining 670 yuan would be the employee's personal income. The person in charge has promised that employee loans will be risk-free. Ms. Wu, who helped the group with a 1-year loan of 120,000 yuan, revealed that when the group first asked her to help with the loan, she applied for a decoration loan, and Ms. Wu didn't even own a house at that time. What made Ms. Wu even more desperate was that when her first loan was due, the group that promised to repay it when it was due notified that the situation had changed. Regarding the doubts about the compliance of banking business, the account manager of Jinshui branch of Zhengzhou Rural Commercial Bank in charge of the employee loan business of Zhengzhou Yuran Education Group said that reviewing the loan purpose was not within his business scope. It is worth noting that as early as May 2021, Zhengzhou Rural Commercial Bank was fined 2.744 million yuan by the Zhengzhou Central Branch of the People's Bank of China for suspected of 9 violations, including false reporting and concealment of financial statistics. In addition, Zhengzhou Lingxiu Clothing Company, the owner of Zhengzhou Rural Commercial Bank, has been listed as a dishonest company by the court 7 times. Dramatic turning point in US-China Chip War? The new Huawei smartphone with 7nm technology flies in the face of international sanctions on exporting the tech to China. In the article China's New Chip Could Change Everything, published September 7, author Milton Ezrati, the chief economist of Vested, presented an analysis about this striking incident. Now, China seems to have opened another front in its chip war with the United States. Despite Washington's bans on the sale of advanced semiconductors and chip-making equipment to China, the Shanghai-based Semiconductor Manufacturing International Corporation, SMIC, now seems to have domestic access to advanced chips that could render moot the American bans. Given the history of technology and innovation, it was only ever a question of time before Beijing found a way to work around the American-inspired bans. Still, that event seems to have occurred more quickly and with more drama than anyone expected when the U.S. restrictions went into effect last year. Now, it is time for Washington to make the next move in the Sino-American tit-for-tat technology war. The Biden administration's effort to thwart Chinese technology ambitions built mostly on the 2022 CHIPS and Science Act. It allotted subsidies to chip manufacturers to build operations in the United States and, at the same, instituted bans on the sale of advanced semiconductors and chip-making technologies to China. Its biggest success arrived soon after the legislation passed when the White House convinced Japan and the Netherlands to comply with its provisions. Especially significant was the agreement by the Netherlands-based ASML holding company to stop sales to China of its most advanced extreme ultraviolet lithography machines for the manufacture of semiconductors. At the time of the agreement, ASML's leadership insisted that the ban would only encourage the Chinese to develop similar equipment for themselves and that it was only a matter of time before that day would arrive. Now, even sooner than ASML's management expected, China seems to have done just that. According to the Beijing-based publication Securities Daily, the Shanghai-based Microelectronics Equipment Group has developed a lithography machine capable of producing transistors comparable to those produced by ASML equipment and needed for advanced smartphones, computers, and cutting-edge weapons. The issue was always a matter of size. The smaller the transistors a machine can make, the more it can fit on a chip. It was thought that China could not make transistors smaller than 7 nanometers, the scale used to measure their size. Now, it seems the Chinese have broken that barrier and are now verging on even smaller transistors of 5 nanometers. 2 unanswered questions now remain. How do the new Chinese machines compare to existing equipment in the United States, Japan, and the Netherlands? How fast can the Chinese leverage this breakthrough to accelerate the development of advanced chips? If the answers to these 2 questions include a lot of caveats and delays, then China's breakthrough will wait until it can make a difference in the Sino-American chip wars. If the answer is that it compares well and can ramp up quickly, then China will have clearly won this round, and the competition with the United States will move on to other matters. If 2 questions remain, Beijing's quick response to Washington's bans offers at least one important lesson to economic and diplomatic strategists. Any bans, such as Washington arranged in 2022, seldom can have any lasting effect, especially when, as in the case of the Chips and Science Act, they aim to stop the spread of technology. The management of ASML looks strikingly prescient with its warning about what China would do. In a broader context, there is a second lesson. It concerns the kind of industrial policy behind the Chips and Science Act, and Bidenomics for that matter. Because it is impossible to see the future, any sweeping gesture, by the government or a company, will often miss the mark. Take Washington's bans on sales of chips and chip-making equipment to China. The specifics in the law necessarily settled on circumstances as they existed at the time it was passed, who possessed which technologies, and what technologies were ascendant. But things are always developing in economics, especially where technologies are concerned. In this instance, China seems to have caught up with the West, making the bans moot. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.